Hey, good morning. Morning, everyone.
Good morning, Professor.
Hey, good morning, Samira. Uh, how's everybody else? Hello. I see um, I see
Doing good.
five people. Hey, good morning. Good morning, Al. Um, so we have five people, right? And hi, Zachariah. Um,
Good morning, Professor.
hey, good morning. Good morning. Okay, Lewis, your microphone is broken. I'm sorry to hear that. Um, well, I see a couple of people joining, right? So let's see um, how many people are there in the forum. Okay, I see, yeah, about I see seven people, right? And hopefully more people will join as we go on. So let me, oops, that's not the, let me pull up, mm-mm. Let me pull up the file, Excel file for financial statements. Okay, there's that file. Why isn't it opening? What happened? Oh yeah, there it is. Um, okay. So in our last class, right, um, we were, talking about the inventory, right? Because in uh, the balance sheet, right? What's happening here? In the balance sheet, right? Um, Current assets, right? Non-current assets. Uh, we talked about, everything about, non-current assets, right? Plant and equipment, right? Land and building, right? All physical, right? In current assets, cash and cash equivalents. And accounts, promissory notes, and marketable securities. I mean, before that. How do I? Okay. Marketable securities, which are stocks and bonds, basically, right? And then promissory notes. Uh, I'm not gonna write the whole thing. Uh, P notes. I'll just call it uh, promissory notes uh, and accounts receivable and inventory, right? So we talked about if you think about it, inventory, the whole current assets are basically liquid in nature, liquid, right? Everything is, they are all liquid assets. But among liquid here means, easily converted into cash. Inventory can also be converted into cash, but inventory takes more time because it's not. Inventory is the only physical asset among current assets, physical in nature. right? It can be, of course, it is liquid assets in terms that it can be converted into cash. But it's physical in nature, right? I mean, uh, it's, but it's not physical like plant and equipment, right? Plant and equipment, to liquidate plant and equipment, it will take a long time. It's not something that can be easily converted into cash, right? That's why it's non-current assets. Whereas inventory can relatively be easily converted into cash. You can liquidate them easily. I mean, um, a clothing store, right? Clothing store, garment and apparel. They have lots of inventory, which are basically finished goods, right? And if they are running into cash flow shortage, then they can easily liquidate their inventory of clothes. All those things are, if you put it on, discount sale, right? If you put it on, like, fire sale, it will be liquidated easily. But it's but it's not as easily liquidable like marketable securities or promissory notes and accounts receivable, right? So inventory is the only thing that is physical in nature among current assets. And but so we basically discussed inventory last time, especially in case of manufacturing. And then one line item that we left out, which is a promissory notes and accounts receivable. Okay. So we understand what promissory notes are. Okay, come on. So, okay, let me do this. So promissory notes are IOUs, used only IOUs only in B2B, right? And some people think you can write a promissory note. I mean, an individual can write a promissory note. Yes, individuals can write a promissory note, but it cannot be used as a payment. It cannot be used as payment, right? Between individuals, you can write an IOU, but for it to have a legal effect, you must have it certified or notarized. But then even if you have it notarized, it's just between close circle. I mean, family and friends, between family and friends, and then in most cases, if you are very, trustworthy, a person, then, your family and friends will accept a promissory note and lend you money. But if you are not very trustworthy, either they won't lend you any money against the promissory note, or they will just give you the money, knowing that the promissory note is nothing but a piece of paper, no matter how notarized it is. It's just because, as a family member, they, as a family member, they love you, and they just, are willing to give you money and forget about getting it back. So, but again, as I said, personal promissory note is only within that closed circle, in a personal circle. You can never use it as a method, a payment method, right? Um, but promissory notes in B2B, right, business to business context, um, it's a commercial paper. Another name for promissory note is commercial paper. And you remember, commercial paper is something that came up previously, right? Where? Do you remember where you heard the term commercial paper? Anyone? Where did it come up? Anybody? No one remembers?
It was in the bond session.
Yeah. In bonds, yes. Uh, uh, what about? I mean, so in bonds. So what do you
We had
remember about?
treasury
Hmm?
notes. It was
No, it's not. It's not treasury. It's not treasury. Treasury is, treasury is U.S. government debt, right? Federal government debt. But commercial paper is.
commercial paper was like a treasury bill, short term.
Yeah,
It's
yeah,
for
yeah.
short term.
It's like treasury bill, but it's like treasury bill.
It's for
But is it?
short term.
Yeah, short term for short term. But
For
it's like.
corporate.
Yeah, you're right. You're right, Samira. So what's today? 15th, right? Section. This is section 1101. Yeah, Samira. Okay. Uh, you got 1 point for that. 1 point, right? Yeah. Commercial paper is short-term corporate bond, right? So think about it. Um, if promissory note is also called commercial paper, right? Then that means, yeah, promissory note is short-term corporate borrowing, right? Corporate short-term debt, right? Corporate debt. Now, then, how does that? Uh, Commercial paper can be, in other words, promissory notes can be issued uh, in one of the two, under one of the two circumstances. One, as a means of payment, as a method of payment, right? Uh, as in our example, right? Our example is Dell and Best Buy. Between Dell and Best Buy, um, it's a retailer. They buy 1,000 laptops, computers from Dell, and and Dell each model. It's the same model, but each computer is $300, right? When Dell sells it to Best Buy, so they bought 1,000, so the total will be 300,000, and uh, so Best Buy can pay with promissory note in the face value of 300,000. Okay, um, uh, that's case number one. And case number two, I said it can be used in under two different circumstances. Uh, second circumstance is uh, corporations. Uh, corporations don't have to use this as payment, but they can just sell it in the bond market just to uh, um, just borrow capital for short term, right? It's the same thing. I mean, think about it. If they pay, so let me. So promissory note basically looks like a check. It looks like a check. Uh, and it's going to have face value here, 300K. But it's gonna have interest rate, let's say 10% APR, and then maturity due 60 days, right? Due 60 days. You know, stays. Uh-oh. Due 60 days. Okay. So two things that are different, right? Two things that make it different from a check is that it carries interest and it has maturity. So why? Of course, because it is short-term borrowing. In other words, promissory note is a deferred payment, right? Think about it. When Best Buy buys, when Best Buy buys 1,000 computers, right? 1,000 units, 1,000 computers from Dell, right? They have, in B2B, they have 4 payment modalities or 4 payment methods, right? Of course, the first one is cash, right? They can pay with cash. Second, they pay with check. 3, they can pay with a credit card. 4, they can pay with promissory notes. Okay. And if you think about it, from seller's perspective, cash is the most preferred method of payment, right? And in this order, right? In other words, from the seller's perspective, that's the direction of preference, right? But from the buyer's perspective, that's the direction of preference, right? First, if they pay cash, this 300K is gone, right? Best Buy won't have this 300K anymore. And you might wonder, you might think, isn't it obvious? I mean, isn't it just, isn't it natural? I mean, when you buy something, you have to pay, and then you don't have the money. You cannot have, you cannot eat the cake and have it at the same time, right? True, but then if they pay with check, it will take check takes just about 3 days to a week for check to clear. Check normally takes 3 to a maximum of 7 days to clear. So while it is in float, it's called float, right? While the check is still not cleared, during that period, actually, if it is 1 week, it's called float. This 300K appears in both accounts, right? It still appears in Best Buy's account, and it also appears in Dell's account, right? But once the check is deposited, before it to clear, right? Of course, in Dell's account, it's pending, right? The deposit check is pending. The deposited check is pending, right? 300K is pending. So that that interim period during which, the check is pending, right? It's as if, Dell has, Dell cannot use it, but it appears in both accounts. Now, if they use credit card, Dell gets it right away. They will get it right away. But Best Buy can buy time up to a month, right? The payment they don't have to make the payment for a month, so they can defer the payment up to a month. In case of check, they can defer payment up to a week, 3 days to a week, right? But if you pay with promissory note, it can be 30 days, 60 days, 90 days, 120 days, or 180 days. Theoretically, even up to 270 days or 360 days, even, right? Theoretically, only theoretically. In reality, they don't accept promissory notes that has longer than generally, anything above 60 days, generally not used, because it's almost, it's very rude, I mean, not just, I mean, rather, what should I say? It's inappropriate. I mean, in B2B, obviously it's based on the mutual respect. But if the buyer just throws a like 180-day promissory note to the seller, the seller is clearly quite obviously not happy, because for 180 days you won't have the cash flow. You won't get the money. But that's why they are paying interest. That's why they are paying interest, right? To appease the not to upset or to minimize upsetting the seller. But reality is, even though but in reality, between the buyer and seller, the relationship is not on a level playing field, right? Sometimes, I mean, Best Buy is a big industry in retail industry and consumer electronics. Best Buy is a big company. It's a giant, industry giant in retail giant. But Dell is also an industry giant in computer manufacturing. Dell is an industry giant. So the power politics. I mean, there's a balance of power. I mean, one company cannot necessarily treat the other company like a shit, right? But in most cases, there is no balance of power in. There's an imbalance in power politics between the buyer and seller. Usually, buyer is if the buyer is a large company, big company, industry giant, and the seller is a small vendor, buyers usually flex muscle. Buyers flex muscle, and they use their clout to skew this balance, this power more in their favor. So in other words, if this was not Dell, but if it was a small manufacturer of some parts and components, like mouse or keyboard, right? Best Buy can probably dish out a promissory note with 180-day maturity with very little interest, right? That can be a reality. Or if the seller is a big giant, industry giant, and the buyer is a small guy, the seller may demand cash payment, or promissory note with maturity under 30 days. I mean, in reality, who is the bigger guy, right? Who has more clout in the chain, in the supply chain, wields more power, right? Isn't that obvious? Because a company like Dell, a huge computer manufacturer, right? And then if the buyer is a small retail business, right? Uh, it's seller's market in that case, seller's market, right? Um, and a small buyer may represent only less than 0.1% of the Dell's market share. Then small buyer may not be in a demanding position, right? You hear in the sometimes you see often very often in the movie that some guy causing trouble, and when police comes to arrest him, then he says, well, I pay taxes, so I'm paying your salary. No, that is obviously no a police officer will even um, squint their eyes at that, um, because the salary of the police officer comes from many, a multitude of tax sources. And that individual, that guy, the contribution from that guy's taxes to this police officer's salary may not be even 0.00001%, right? So obviously, that guy was, everybody can understand that, that's, irrational and unreasonable, that guy's claim. So it's just like that. When Dell is it's either buyer's market or seller's market, right? If the buyer is the big guy, industry giant, and buyer, and there are very few buyers, and there are a lot of vendors, right? Then it's buyer's market. Buyer wills this power. Buyer can flex the muscle, and vice versa. If it is seller's market. So anyway, but again, assuming that both a buyer and seller are in a balanced power balance, right? Power politics, or it's not politics, but between the two, that balance of power is maintained. Usually, due date on the maturity on the promissory note is not more than 60 days. But once again, what's the benefit of so when the buyer pays with promissory note, right? And buyer pays with promissory note, what's the benefit? The benefit is, look, when they buy 60 days, right? So think about it. If the buyer, Best Buy, can use this 300K for 60 days, and if they find an investment opportunity, that gives return on investment of 20%, even 10% over even, let's say 20%, or even 10% for that matter. It doesn't matter, because, this 20% is, for 60 days. Over 60 days. If it is, over 60 days, right? It's great. And then think about it. They will pay them. So in 60 days, the maturity value, and 10% is APR. So that means for 60 days, you don't pay 10% over 60 days. You will pay only. You'll have to adjust it. 60 days is it's a partial year, right? 60 days is 1/6 of a year, because it's 60 over 360. It's 160, 1/6 of a year. So, but even if it is 10% over just 60 days, now think about it. Even if this promissory note carries 10%, not APR, but just over 10% over 60 days, then that's going to be 330K, right? And maturity, right? Now, but if Best Buy, in the meantime, Best Buy can invest this, right? And earn 20% return over 60 days, right? Then that's going to be a 360K. So that means, it's worth making that investment, and, pay 10% interest on that promissory note, because this 20% already pays for that 10%, and still have, still leave you with, 10%, right? In other words, is self-financing it, right? If the Best Buy, only if they can find such an investment opportunity. If only they can find such an investment opportunity, right? If only they can find such an investment opportunity. So that's why they are preserving cash is important, because it's you can respond to an opportunity, right? You can respond to an opportunity. On the other hand, from Dell's perspective, right? If they receive promissory note, then they will forego that opportunity to make that 20% 20% investment, 20% investment opportunity, right? They will forego that opportunity. Of course, this investment opportunity may not be available to Dell. This could be a, this could be a private information. Information is, it can be private or public, and all businesses have, and individuals as well. We will, especially institutional investors, they have a lot of, they have more access to private information, right? Anyway, so how the promissory note works, how the promissory note works. So actually, the maturity value on the promissory note, is, I said before, when we did, ROI, we talked about compound interest rate and simple interest rate, and this is exactly where the simple interest rate is being used. And so in simple interest rate, it's principal times 1 plus R times T. Okay, so our principal is 300K times 1 plus interest rate is 10%, right? But that's APR. You must adjust it in 60 days. 60 days is 60 over 360. I mean, this is a business 210. You may have learned it from business 210. Simple interest and simple discount. Very simple, very easy concept, but a lot of people can't get it. In other words, if it is 60, some people try to multiply it by 60, and that's very dumb. Why? Because 60 is days, not years, and this 10% is annual rate. So only if the time is in years, you can multiply 10% directly to that number. But this is not, years. I mean, if you multiply just 60, then that's like 60 years. So obviously you need to make an, if you're a rational person, you understand, you need to make adjustment and turn days into years. And some people might say, how can you turn days into years? Of course, it's a fraction, it's partial, it's fraction, right? 60 days is clearly 1/6 of a year, right? And some people never get it. But doesn't it make sense? We cannot, you cannot multiply annual interest rate to 60 days, right? Because it is annual interest rate, you must convert days, 60 days, into year. It will be a partial year, of course, and we all know it's, 1/6, right? 1/6 of a year. And if you do that, you will come to like 305K. Well, I did 305K. Okay. Just to verify, because I remember, let me use the calculator. Think about it, right? It's 300 times, open parenthesis, 1 plus 0.1, 10%, right? Divided by, times, I'm sorry, times 60 divided by 360, close parenthesis. Yes, right? So what does this mean? So the seller, right? The seller will, if the seller holds it 60 days, the seller holds on to this for 60 days, and on day 60, they present it to the buyer, and then the buyer will pay this, okay? But that's not always the case. That's not always the situation. Why? Okay, what happened? All right. Now, as you know, Dell is a big company, right? Um, and big businesses generally, big companies can hold on to it until maturity because big companies they don't have uh, they usually don't have much cash flow issue, right? Uh, but small companies have cash flow issue. Small companies do have cash flow issues. In other words, a lot of small companies don't have very tight cash flows, so they cannot wait 60 days. So what do? When they receive the promissory notes, um, they generally take it to the bank right away and sell it to the bank, right? Why? Because they need liquidity, they need cash flow. So usually, um, they can hold it for 10 days, they can hold it for 20 days. I mean, they can hold, uh, but uh, if you think originally you thought you could hold on to it, you didn't expect any cash flow issue um, at time zero, but as time goes on, suddenly your cash flow situation worsened. Then in that case, you can take it to the bank even on day 50 or on day 40 or on day 30, but normally with small businesses, what they do is they just take it to the bank. And then what do they do? They sell this to the bank. So if they sell it to the bank, you think you will get 305K. No, they don't get they don't get the full maturity value. Why? If the bank buys it, right? If the bank buys it, what does that mean? The bank will uh, take the risk. What kind of risk? The risk of default, right? Promissory note is a short-term debt, so there is always a default risk, right? Of course, if it is a company like Best Buy, the default risk may would be low, but if it is not from a very highly rated company, right? Think about it. Remember, um, not all the companies have the same credit rating, right? If the credit rating is low, right, then there is a high default risk, and the bank obviously, I wouldn't want to take over. I wouldn't want to take it over. But if bank takes over, that means for the remaining 60 days, the bank will take over the risk. The bank will also take the risk when they take over um, the promissory note. They will also take over the risk, right? So that necessitates some uh, premium for doing that, or they won't do it for free, so they will discount it, right? It's called bank discount or simple discount. It's discounting using the simple interest rate, right? So usually what they break, so what they get, so let's, if they break it up, um, so they will use some discount rate and break it up into, so let's say something like, 300K and 5K. So in other words, bank will take this and just give this to the to Dell, right? This is called proceeds, and this is called, bank discount. This is what the bank gets, right? This is bank's cut, right? So in other words, the bank will, this is service fee in a way, because no one will do this for free, right? Because they are taking over the risk. And of course, this is just an example. It's not always like broken up like this. It's not always broken up like this. Sometimes it could be, it could be 280. Then it's going to be, this one will have to be 7K, right? And then think about it. They paid 300K to Dell, and bank holds it for 60 days. And on day 60, right? On day 60, bank collects it. The bank collects it from Best Buy, right? The bank presents it to the Best Buy and collect 305K. So that way, bank makes 5K. Okay. So this is called, so this process is called factoring, right? So why did this come up? You need to remember why this came up. This came up because we were talking about the promissory note. Okay. We've been talking about the promissory note and how promissory note works. Actually, if Dell has two choices. They can hold it for 60 days and collect it on day 60 from Best Buy, the entire 305, right? The full maturity value. Or they can sell it to the bank. They can sell it to the bank and collect, smaller amount, but after bank discount, right? Collect smaller amount, but it's better than going bankrupt. It's better than defaulting on. If they don't have enough cash flow and they have constantly, right? They have current liabilities. What are current liabilities? Current liabilities are short-term payment obligations that become due anytime within 1 year, right? So to meet this short-term debt, you have to meet that with current assets. You need to meet that with current assets. But if you don't have enough cash in the current assets, you can't meet it. And if you can't meet it, then you default, right? That could be the cause of bankruptcy. It can lead to bankruptcy. So it's better than going bankrupt for not being able to meet just because you have a low short-term liquidity. So this is mathematically called simple discount because it's a discounting using the simple interest rate. But in the industry, in other words, in the banking industry, or it's called factoring. Okay. And the word factoring, right? You might think that must be the same factor as um, as in the phrase, like we use factor analysis. I mean, the factors that we used in the factor analysis are this and this and that, or this is the main factor in or multiply this by factor of 10. I mean, those usages of the word factor are completely have a different origin. I mean, the word factoring here has completely different origin, completely different um, etymology, right? Um, so uh, we're gonna talk about that more about that after the break. It's 11:52, so it's about time to take a break. So let's take a 10-minute, right? 10-minute break and reconvene at 12:03. All right. Okay. So see you then. All right, we're back. We're back. For a minute, my computer, the browser froze up, and took me a while to close it and reopen. Um, so we were previously talking about the. Okay, where is that? Okay. Um, what factoring is, and I told you the word factoring actually comes from uh, a complete different origin, right? When we say normally say factor, as in the usage, in most common usage, where we use the word factor as in uh, factor analysis. What was the main factor? What's the main factor? Something like that. But it comes from a different origin. And what is that? So why is it called factoring? Um, because it comes from the word. It comes from the word uh, facture in French, right? This is French, and in most Romance languages, like in Italian, it's fattora or fattura. I think it is fattura. Fattura. In Italian, and factora in Spanish. Um, so they all mean the same thing. I mean, the French and Italians and Spanish are all, Romance languages, so they have cognates, and they all mean these cognates mean all the same thing. What does that mean? Hmm? What does that mean? They all mean, invoice, right? They all mean invoice. So, when that word came into English, it got anglicized and became factor, right? So actually, I said when Dell received this promissory note, they take it to the bank to sell it, right? Um, and it's called factoring. So when they take it to the bank, it's not only the bank. They take it to they not only take it to a bank, but also to it's either uh, it can be a bank or it can be a financial company. Financial firm that specializes in uh, promissory notes and invoices. Um, so these are called factors. Okay, so originally the word meant invoice. Ah, what did I do? The word meant invoice in these languages, but it uh, it came to mean, in English language, it came to mean the financial company that specializes in buying and discounting, invoices and promissory notes. So that also means invoice invoice is a big part. Invoice works like, invoices work exactly like promissory notes, right? Um, and also, interesting thing is, it's not only in these languages, but also um, in Czech, right? Czechoslovakian. In Czech, which is a Slavic language. The word for invoice is faktura. Faktura. Right, written this way. And it's Czech. Even in Czech, the interesting thing that was an interesting thing because I've been to Czechoslovakia. I mean, now it is Czech Republic, and Slovakia is a separate country. And Czechoslovakian is basically a Slavic language. The word Slovakia is already clear. So most of the words are similar to Russian. And one thing that is very common in all Slavic languages is that the word for bridge, which is most in Russian, also in Czech is most, and I believe in most other Slavic languages also most. I mean, a lot of it's not just that. A lot of the lexicon, a lot of lexicons are quite similar to Russian, but only this is factura is an exception. Of course, some words can be influenced by some other languages. In German, it's completely invoice is different, completely different in German. Russian is completely different, but in Czech it was factura. And where would have the English word factoring could have come from? They all came from. It all came from this. I forgot. You just do this and then it's arrow. So and invoice is, if you think about it, invoice is actually the physical form of the accounts receivable. Now think about it. Promissory notes. Promissory note is both a concept as well as the physical form of the promissory note. In other words, what should I say? That's weird to. I mean, it's not easy to put it this way, but if you think about it, both promissory note and accounts receivable are credit sales, right? So if they are both credit sales, and it looks like promissory note is the same thing as accounts receivable, yes, promissory note is an accounts receivable, a kind of accounts receivable, but why is it written as a separate line item? Well, because it two reasons. One, there wasn't any. It could have been that there was no credit sale at all. There was no sale. It's just, as I said previously, they can just sell promissory note as short-term debt. You understand? Commercial paper, right? It's a short-term debt. So then there was no sale. You just, no sale of any product, no goods. It's just the an instrument of short-term borrowing. Okay. And then, two, even if it is a credit sale, then promissory note is initiated by the buyer, right? It's a credit sale initiated by the buyer because no seller prefers to receive promissory note, but seller pays with promissory note. And then what choice do you have? So big customer, you don't want to upset a big customer, so you accept promissory note. And then accounts receivable is only a concept, isn't it right? What is an accounts receivable? Now you know it means invoice, but accounts receivable is only a it's an idea, it's a notion, right? Abstract noun. It's an abstract noun, accounts receivable, right? What is the physical form of the accounts receivable? I told you already, invoice. Invoice is the physical form of accounts receivable. But then if you think about it, accounts receivable is credit sale initiated by the seller. Why? The seller in most B2B, right? In most B2B context, the sellers, when the order is placed, the sellers deliver that order, right? Without getting paid first. I mean, if there is an ongoing business relationship, right? If there's an ongoing business relationship, you may have noticed, if you have a bakery, you will need, flour, sugar, and yeast, and I mean, basically, you need these things for raw materials, right? For baking. And then you place an order for flour. Uh, you have a merchant or vendor that supplies flour or sugar or other ingredients. And if you have you have this ongoing business relationship. When you have ongoing business relationship, when you place an order, they ship it, they deliver it, but they don't you don't pay right there, or you don't pay in advance, or you don't pay right there, right? You pay later at the end of the month, something like at the end of the month, or right? So because there is follow-on order, right, during the month. Let's say you have to order flour and sugar, let's say 4 times or 5 times in a given month, and then you don't pay every time they deliver. You just pay at the end of the month, for the whole 5 orders, right? And this is because there's an ongoing business relationship between the vendor and you. So just like that, when they deliver the order, they just drop off the invoice, right? And then at the end of the month, they collect the invoice. In other words, accounts receivable, invoice amount. So it's a credit sale initiated by the seller, right? So that's why that's how promissory note is different from accounts receivable, right? Or invoice. And then when you have invoice, oops, what am I doing? The invoice is basically discounted, right? All those invoices are discounted exactly in the same way as promissory notes are discounted. So because think about it, in factoring, invoices are quite relevant. Invoices are inevitable in factoring. And the word factoring comes already from the word, invoice. That means invoice, right? These words. Okay. So that explains everything about the current assets and the current liabilities, right? The current liabilities are short-term payment obligations, right? I told you that mature anytime within 1 year. And those are accounts payable, notes payable, interest payment, accrued wages. Now, Accounts payable is what? Literally, if you have invoices, right? It's your accounts payable, and it's there, your vendors' accounts receivable, right? They're receivable, you're payable. And notes payable, this is the promissory notes that you issued, right? Promissory notes that you issued, right? And they will generally become due within, 60 days, 30 days, Most businesses want to collect within 45 days, right? And then, otherwise they will take it to the a factor, right? A bank, a factor or a bank. So that's, that brings us to the, everything, that brings us to the conclusion of the, because we have already, explained, I have explained everything about the balance sheet. So the point is then, we know the conclusion of the income statement is the profit or loss, right? But the conclusion of the, the purpose of the income statement, the purpose of the balance sheet is capital structure, right? And the so in our example, capital structure is like 60% equity, 40% debt, right? And liabilities and equity side is the source of capital. This is not working. Source of capital, right? And so where the capital came from, asset side, how the capital is held, right? In what form the capital is held or the use of the capital. So at the beginning of this topic, I said, in topic 1, we looked at ROI from macroeconomic perspective, but in topic 2, we're looking at ROI from the firm's microeconomic perspective or the firm's perspective, right? So from the firm's perspective, ROI is can be measured by ROE and ROA, right? Return on equity and return on assets. So the when we see return on equity, return on assets, it's clear. Return means a profit, right? Return from business. How else would you measure the return from a business? A profit. But then, what was the then investment? What was the initial investment? Well, total assets is the dollar amount of investment that went into it, right? Isn't that right? In other words, a business, a company is like a tree. I don't know if you've ever thought about it this way. A company is like a tree, right? Let's say an apple tree or whatever. Company is basically like a tree. And then I told you, a company is a vehicle, right? A company is a vehicle to generate income and pass that income to here. Basically, eventually it will have to that income will result in the profit, and they will the company. The sole purpose of a company is to serve as a vehicle to pass that profit to the shareholders, right? So think about it. this way. If you are a farmer and if you have an apple tree, right? That apple tree is your asset. And the assets, so apple tree is your asset. And if you have 10 apple trees, those 10 apple trees are your total assets, right? But the assets came from equity and debt, right? It's obvious, isn't it, right? It came from equity and debt. 60% from equity, 40% from debt. Okay, let's say, so that apple tree, let's say that apple tree is, worth $1,000. Okay, or $1 million. It's an apple tree that bears, golden apples, right? $1 million. Oops. $1 million. Right? So 600K came from equity, 400K came from debt. And then in fall, right? In the harvest season, you're going to have a lot of apples there. You're going to have so those apples are what? Those apples are your profits. Those apples are your profit, right? Or output. Those are your output. And this tree, calling it an input is a little weird, but but we can consider that as input, right? Right? But anyway, that you put in $1 million. You put in $1 million into this business or into this project, and the outcome is the profit, right? So it's input, output over input. In other words, the ROI is, if you think about it, what is ROI? ROI is profit over total assets, right? So that's exactly output to input ratio, right? It's exactly output to input ratio. And if you think about it, there is no better way, or this is the only way to measure the productivity or efficiency, right? Productivity or efficiency. Basically, productivity is how much output for given input. And then what is efficiency? Productivity and efficiency are closely related. In other words, higher productivity means efficiency. Higher productivity means efficiency. Low productivity means inefficient. right? For example, you know what fuel economy is. What's a fuel economy? Everyone knows what fuel economy is. What's a fuel economy? Anyone? Another name for fuel economy is gas mileage, right? Isn't that right? What's, so we all know what fuel economy is. It's basically, gas mileage or fuel economy. That's what? How many miles? Miles run, gallons used, right? How many gallons of gas, right? Miles run over gallons used. And, think about it. The higher this number, right, the more fuel efficient the car is, or the higher, you get better gas mileage, right? Nobody would nobody would not like high gas mileage. Isn't that right? Is there anyone who doesn't like high gas mileage? Good gas mileage, is there anyone? Huh? Especially these days, the gas price is so high. It's basically, uh, I all above $4, 4.50 for something. In California, it's even $6, six something. That's crazy. And we know um, uh, there are gas guzzlers. Like if you drive an SUV, some people drive like big SUVs like Ford Expedition or Cadillac Escalade. Um, Basically, Ford Expedition has the same body, same same chassis as a Ford truck F-150, right? And these trucks and SUVs um, get only like 5 miles per gallon or 8 miles per gallon. That's the gas mileage of a tank. A 60 ton, a 60 ton M1 Abrams will probably get 2 miles per gallon, or probably 3 miles per gallon. But uh, if you have if you're driving a truck like uh, Ford F-150, uh, and these people, they shouldn't complain. They shouldn't complain about the gas price. They knew these are gas guzzlers, and if they were even, a little bit concerned about the uh, fuel economy, they wouldn't, they wouldn't drive an SUV like, Escalade or Ford Expedition, and they only drive 1 mile, and from home to work, it's only 1 mile. um, but they have to have a big SUV, big. It has to be a big SUV. Getting only 5 miles per gallon and polluting the air. Um, and personally, I find SUVs those trucks and SUVs very selfish vehicle, and very insensitive and rude vehicles. Why? Because if they are in front of you, I mean, if uh, it's completely, if you're driving a small car, it's completely blocking your view. It's completely blocking the view of the vehicles behind them. They don't care. They just block the whole lane, and driving, even too slowly for even on the highway. Uh, And interesting thing is those trucks, they drive very fast, you know. So it's even, you know, intimidating, you know, small, you know, vehicles in front of them. But anyway, if they once they are in front of you, they block the whole view, right? They block the entire lane because they take up entire lane, you know. So one thing is clear, you know, we know why people prefer, you know, high gas mileage because it's more efficient. And then it's the same idea. It's the same thing, right? What is return on ROA? What's ROA? So it's just like the gas mileage, right? It measures the productivity or profitability, right, of the business. Also, ROA, it's basically output to input ratio. But now, what is ROE? Of course, ROE is profit over equity. Because think about it, from the equity holder's perspective, in other words, shareholders' perspective, from the shareholders' perspective, right? Profit belongs to them. Profit belongs to the shareholders, isn't that right? Profit belongs to the shareholders, right? But total assets, so it's a direct measure of productivity or the profitability of their equity, right? Because it's that output belongs to only to equity holders. But then we all know total assets is equity plus debt, right? And this profit only belongs to equity holders, but not to the debt holders. It doesn't belong to the debt holders, right? So you have to make this very clear, right? Profit doesn't, none of the profit goes to the debt holders. Debt holders, they get their return is actually interest and the principal, right? Actually, interest is the only return. Principal is their initial investment, right? Principal is their only their initial investment. So for their return is only interest. Right? They only get interest. So but then think about it. From the debt holders, right? Again, these terms must be, you know, by now you should be clear about these terms, you know, bond holder, debt holder, because bond is debt, creditors, and lenders, they all mean the same thing, right? They all mean the same thing. They're not different things. They all mean the same thing. So from the debt holder's perspective, right, or the bondholder's perspective, right, this is okay. ROE is completely irrelevant to them. ROE is irrelevant to them. Then what should they look? What should they look? Where should they look to use as a metric, or to use as a gauge, to a metric to gauge the profitability? And they will have to look at, right? They will have to look at the ROA. Okay, that's the only way. They will have to look at the ROA, right? All righty. So that's all the time we have. Any questions so far? Any questions? Any questions? No? I see. What happened? Only 8 people? All righty. I will take that as no. Okay. So if there are no questions, then the class is dismissed. Have a great afternoon, everyone.
All right, thank you.
Thank you,
All right.
Professor. You too.
All righty. You too. I will see you guys on
Take care,
Thursday.
Professor.
All right. Thank you. You too, Anna. All righty. So I'm going to stop recording.